Hello everyone, welcome back to the world of technical analysis, and in continuation to what we have been discussing so far, in this series of videos, we will be talking about chart patterns. You would have often heard TV analysts and astute investors talking about various types of pattern formations in the stock price movement. Let's try to decode these. Chart patterns can be broadly classified into two categories, a reversal pattern or a continuation pattern. So reversal patterns, as the name suggests, it indicates a temporary pause or a reversal of the ongoing trend. For example, if a stock is in a bull run, a bullish reversal pattern would mean that the bull run may take a temporary pause and a corrective phase may kick in. And conversely, a continuation pattern would indicate that the pattern or the trend continues. For example, if a stock is in a visible uptrend, a continuation pattern may indicate that the uptrend may consolidate for some time and the trend will continue further. So before we get into the discussions of various types of chart patterns, it is imperative that we discuss and try to understand what these chart patterns try to convey. Broadly speaking, these chart patterns try to convey the overall market sentiment or psychology, which is very difficult to gauge. But when you look at the price action over a defined period of time, you get very meaningful insights which will give you a definitive edge in your trading or investment journey. Also remember that whenever you are looking at chart patterns, the higher time frame charts have more significance as compared to a lower time frame chart. Meaning, if I am looking at a pattern being developed on a weekly or a monthly time frame chart, that holds more meaning and significance as compared to a similar pattern being developed in a daily or a hourly time frame chart. So, two basic rules. Number one, these patterns convey the market sentiment or psychology around that given stock. And number two, a higher time frame chart holds more significance as compared to a lower time frame chart. So without much ado, let's talk about some bearish reversal patterns to begin with. If you are able to see my screen, I have plotted three different types of bearish reversal patterns which I would be covering in this video. The first one being a rounding bottom pattern. There are certain rules that we should be mindful of whenever we are looking at patterns. And if we are able to apply these rules and techniques while trying to identify patterns, your probability of success in your trading decision would be much higher. So if you notice here, the stock is in a visible downtrend with the EMAs acting as a resistance. And if you notice, once this downtrend is bottoming out, these EMAs have now started acting as a support. And finally, the shorter period EMAs are converging with the longer period EMAs, which mean that in the shorter period, the price action and the momentum is much higher as compared to the longer period. So this is typically an indication of the completion of the pattern. And if I notice, I can also use various oscillators like RSI and MACD, which we have covered in our previous videos, which will help me prove or attest my theory and observation. So as I can see, I am having a visible positive divergence in the RSI here, and I am also able to see that the MACD is venturing into the positive territory from the negative territory. So these are all very positive indications that the pattern seems to be now complete, and upon the completion of the pattern, you would see that the stock price volatility is low as compared to the prior period. If you notice the length of the real body candles here, they have huge variations or huge margins. The low and the high price have a huge gap. But when the pattern seems to be complete, the stock price consolidates and it's very range bound or the band is very narrow. So these are very good indication signs that your pattern seems to be now complete. And since we are looking at this pattern formation on a weekly time frame, I can switch back to a lower time frame to define my entry and stop loss. Moving on, a slight variation to the rounding bottom pattern can be classified as a cup and a handle pattern. As the name suggests, it's very similar to a cup and a handle. So taking the same example further, the same stock, see it on a weekly time frame, I have drawn it in the form of a cup and a handle pattern, and the rules remain the same. The stock is in a prior downtrend with the EMAs acting as a resistance. And once the pattern seems to be complete, the EMAs have now started providing support to the price movement. And the shorter period EMAs are converging with the longer period EMAs, indicating that the price action in the shorter period has more momentum and speed. And we can also use our oscillator tools like RSI or MACD to further attest or to validate our premise. And as I said earlier, once the pattern formation seems complete, you can switch over to a lower time frame like a daily chart or a 4-hourly chart, and you can define your entry points and your stop loss and your target points. And the final variation of a bearish reversal pattern is an inverted head and shoulder pattern. The reason we call it a head and shoulder is because it is very similar to our human body, a shoulder, a head and a shoulder. And in case of a bearish reversal pattern, it's an inverted one, which means your left shoulder, your body and your right shoulder. So as you are able to see on my screen, I have drawn this left shoulder, a body and a right shoulder, and the rules are broadly the same. Your stock should be in a visible downtrend and your EMA should be acting as a resistance. Your shorter period EMAs start converging with your longer period EMAs, and that is indicative of completion of your pattern. You can also use oscillators like RSI or MACD to further validate your view on the chart and pattern formation. So as you can see, we have a hidden bullish divergence on the RSI and we have a bullish crossover on MACD, and it is still in the positive territory. And given that this chart would be on a higher time frame, I always have the option to go to a smaller time frame to define my entry and exit points. So these are the patterns: the rounding bottom pattern, a cup and a handle pattern, or an inverted head and shoulder pattern, which are typically the signs of a bearish reversal patterns, wherein your bear phase is taking a temporary pause and a momentary corrective phase or a bull phase may kick in. Do remember, patterns are not an absolute science, similar to how we said that technical analysis is not an absolute science. Patterns can fail, but if you are able to apply the various techniques like EMAs, which were acting as a resistance and have started acting as a support, the convergence of the EMAs, these will help you take better and more informed trading decisions. And someone who is an aggressive trader, he might want to take the entry right here. Reason being that the EMAs are giving a very nice convergence here and there is a gap up opening in the stock price. So this can also be a very good view, but this kind of views will only come with practice and with discipline. So don't rush into taking a trade or don't rush into making ill-informed decisions. When you are seeing a pattern being formed, you need to wait for the pattern to be complete. If you rush into taking a trade, you may fail, and that may deter you from your further trades or investing decision. So always remember, discipline, practice and perseverance is what will give you the reward that the stock market has in place, and that is what we are trying to tap as a part of technical analysis. So I hope that this was informative, and in the subsequent videos we'll talk about the various bullish reversal patterns and the continuation patterns. Thank you.